Hi guys, welcome into today's video. And in today's video, I'm going to go ahead and give my updated projections for Zeta Global Holdings. This is a stock that's currently one of my largest positions in my portfolio. It's one of my highest conviction names and one of the names I believe has some of the best upside potential that I currently hold in my portfolio. And I wanted to give my updated numbers. I went ahead and ran. These numbers were updated based on their performance in the first quarter earnings. And I realized I hadn't really updated my original projection, so I went ahead and did that today, and I just want to share that with y'all based on some of the outperformance they've been doing and the trends I'm seeing in the business. So first off, just starting on the actual stock price. For the performance, year to date, the company's still down 8%, but it has seen some momentum lately. As we can see today, it was up 4%, and it closed the day up 4%. In the past week, it's been up 8.3%. And in the month, it's only up 2.5%. But we can see recently it's had a bit of momentum. So if you're new to this company or you don't know what Zeta does, the easiest way I can explain it is they are an AI data marketing company. So if you're a business, you come do business with Zeta, and Zeta will run your marketing for you. That involves running different ad campaigns, helping with some creatives, and then also just putting those actual ads and helping you put them in front of the correct customers that gives a higher chance for that customer to go ahead and buy your product. Now you may be asking, okay, what makes them different? I'm sure there's a lot of marketing companies, a lot of these AI tools, these generative AI tools, LLMs. A lot of people have access to this stuff. So what makes them different? What makes them unique? Why am I personally invested in them? Glad you asked. The one thing I'd say with them that makes them a big differentiator and I think actually puts a moat on the business is the data. So if you're thinking about these AI platforms and the LLMs and everything like that, it's only as good as the data that's being fed into it. And the thing with Zeta is they have a lot of proprietary data. They actually have the largest third-party data set in their market, with currently a data set of 550 million individuals, 300 million being Americans, and each individual on average, I believe it's 7,000 attributes an individual. And the reason this is so valuable is the best way I can describe this is in an example. Let's say you're Nike. Let's say you're Nike and you would like to advertise and you go to Zeta. Hey, we're going to have you run our marketing. Well, Nike obviously has a lot of their own first party data from their website, different traffic. All companies hold their own data that they've been collecting, important metrics on their customers, yada, yada. Nike plugs that in, right? But let's say if Nike were to go advertise, they know the ones that maybe are following that they have data on. They maybe know the information on those customers that they have data on, ones that maybe opted into their newsletter, different things like that. And then they know to go put an advertisement in front of them and they're likely to spend. But what about somebody who may be looking to buy another shoe, for example, but they haven't popped up on Nike's radar or Nike doesn't have them anywhere in their system? Chances are, with the amount of data that Zeta has, they are popping up on Zeta's system, and Zeta knows, okay, this person is looking for a running shoe, let's say, but maybe they see, okay, they're searching up different running shoe brands like Hoka, stuff like that, maybe Under Armour, just spitballing different names, but they haven't done Nike, so they're not on that radar. But Nike comes to work with Zeta, so now Zeta kind of plugs them into their ZMP network, is what they call it. And now, because Zeta knows this customer over here that originally wasn't on Nike's radar is looking for an actual running shoe, now they know, okay, let's put an ad in front of them for a Nike shoe. And that leads to higher conversion. And that's a very simple way to explain it of why that data really helps. And we can kind of see it in the numbers because the return on ad spend is so good. They have currently around a 600% return on ad spend, but from what the CEO was saying on the call, especially with use of Athena, which is their LLM, they've kind of started implementing on top of their actual data analytics software. They've actually started getting a return on ad spend that's even higher than that. And return on ad spend, you can just think of it as if it's 600%, so it's like, okay, I'm putting $1 in, I'm getting $6 return in terms of sales. So $1 in for advertising, six back, basically. And you could see how, as that number goes higher, businesses are going to want to go to where they can get the highest return on their ad spend. So that's kind of my thesis on the company, or that's kind of the moat I see around the company and why I am so confident and I have so much conviction in this company. And just to kind of give more context to this, let's go ahead and go over here. This is Stock Unlock. This is a platform I kind of use for running a lot of my valuations and things like that. So if we're looking at Zeta Global, if we look at their valuation real quick, they're currently trading at a price to free cash flow of about 25. Their median is typically around the 40 range, so they are trading at more of a discount than they have been in the past. And one thing about this company is they are serial sandbaggers. They typically always come in and give guidance that's undershooting what they're actually going to perform. They've had currently, I believe, as of the last quarter, Q1 2026, it's their 19th consecutive beat and raise quarter. So this company really loves to come in, say, we're going to do this, knowing full well that they are more than likely going to outperform what they're actually guiding for. And they have done it consistently. So knowing this is something I kind of baked into my guidance whenever I was running my valuation metrics and I was forecasting what I believe the future stock price is going to be, just as some context. So with that in mind, right here, this is taken from their investor presentation. They actually had some guidance targets outlined. So these are their 2028 targets for full year. They are targeting $2.3 billion in revenue. I'm going to be focusing on free cash flow for my valuation. 2028, they were forecasting $371 million of free cash flow. Now, my numbers are a little higher than this. Not a crazy amount higher, but slightly higher. And the reason being is because of exactly what I was saying, where they tend to sandbag a lot. And even if you look in this quarter, so in this quarter, they had 50% revenue growth. Their revenue came in at $396 million. They were guiding between, I believe it was a 369 million and 371 million was the guidance for this quarter. And they came in near 400 million. So this company, like I said, always comes in, beats numbers. So I'm factoring that into my valuation whenever I am running that, which I will show y'all in a second. Now, next thing of note over here, if we're looking, I have some companies that are more considered, some of these aren't direct competitors, but I try to get things that were more in that full SaaS space, I guess you could call it. I'd say the Trade Desk is more of a direct competitor, as well as Salesforce and Adobe. But I try to grab a lot of these because they're more lumped into that whole SaaS category. So in terms of valuation, these are the ones I'm kind of looking at to kind of see, okay, what's a fair multiple I can give for the company? And first thing I want to point out, so if we're looking at a CAGR, this is going from about the end of 2020, so beginning 2021, for the free cash flow, Zeta has grown their free cash flow at a CAGR of 72%. Compare that to some of these other ones like the Trade Desk at around 20%, which is still a pretty good clip. ServiceNow 26%, Salesforce 28%, and Adobe 13.5%. And then if we're looking, go ahead and pull up over here their price of free cash flow and see what valuation multiple they were given on these, which I'm going to go ahead and take off the free cash flow for right now, just so it's not so much stuff on screen. If we look at the median, which I like to use because it gets rid of some of the outliers, for Adobe, its median is around just about a 30. Salesforce about a 28. ServiceNow a 51. Palantir a 91, which is very high growth. And then the Trade Desk at a 67. So these I was kind of looking at whenever I was getting the multiples I was going to actually use on my price to free cash flow for the analysis. And as you can see, even it's usually around the 30-ish range. The Trade Desk I kind of see as an outlier because that was only 20% growth, and I think 67 is way too high. At least to me, that seems a little too excessive, so I wanted to be conservative, so I kind of ignored this one. But for some of the other ones, same thing for Palantir, they're extremely high growth, so kind of ignore that one, and the valuation's rich on that. But looking at some of the other ones, we're typically looking around the 30 range, maybe on the higher end, getting into the 40s is something that's possible. So with that out of the way, I'm going to go ahead and pull up my updated projections right here. So something I want to note right here at the top, this I have for my base case just to kind of show. So these are the trailing 12 months revenue as of Q1 2026. I went ahead and ran a 20% growth rate going across. And if we compare this to those 2028 Zeta targets, which is going to be this number right here, not this one because this is just Q1 of 2028. So in actuality, the one that's most comparable with those 2028 targets is this Q1 2029. But I have them nearing about 2.5 billion, which with their actual targets on 2028 for full year, they're targeting 2.3 billion. So I have it ahead by about 200 million, but like I said, they usually come in and beat their numbers pretty consistently, or I should say really consistently, 19 quarters. So I don't expect them to actually meet their guidance. I expect it to beat, which is why I'm factoring that into my base case. Furthermore, I still think I'm being fairly conservative on my revenue growth for this, because in the latest quarter, as we saw, there was 50% revenue growth. Yes, there was a Marigold acquisition that contributed to that revenue growth, but even excluding the acquisition revenue, the company still grew revenues 28% on their organic side from just the organic business, excluding the acquisition, which I believe, if I remember correctly, it was 14% was from their same customers that they actually were able to upsell them on more products, so they were able to charge them more. And then the other 14%, if I remember correctly, it was from actual acquisition of new customers. So new customers, they were just charging. And the longer customers stay with them, they tend to spend more money, just the way their business model works. So with that being said, 28% organically, I think them being able to grow 20% year in, year out for the next 5 years is extremely doable. If anything, I think I'm being very conservative on that, because like I said, they grew 28% organically, not even including Marigold. So if you factor in Marigold, I can make a real strong case that their revenue growth going 5 years out should be averaging closer to 25%, if not 30%. But to be conservative, I kept it at 20%. So with that, I believe that the free cash flow margin, a fair place to put it, is a 30% growth year in, year out. Now, again, if we compare this to what they were projecting on their Zeta 2028 numbers, that has free cash flow at 391 million and a 15.7% cash flow margin, which if we look, that's around what they were actually projecting, and the margin pretty close to that as well. 391, 371, so about 20 million above that, which again I think is really doable, considering they come in and they typically beat their numbers. So by the end of this, going into Q1 of 2031, I'm projecting free cash flow of $660 million. And that brings them to a free cash flow margin right here of about 18.44%, which I think is very fair. And if anything, I think that's very conservative, because if you look at companies more in this SaaS type space, free cash flow margins are typically in the mid 20s, if not some go really high. Like I think Adobe's at a 40%. So if we come back here into our freeform tool, we can go ahead and pull up the free cash flow margin. So if we're looking at these companies, let's first look at the latest. So for Adobe, they're currently putting up 42%. Of course, more mature business model, same thing with Salesforce, but either way, 35%. ServiceNow at 33%. Palantir, an impressive 51%. The Trade Desk at a 27%. Zeta currently is sitting at a 12%. And if we look at the median, 41, 21, 30, 20, 27, and Zeta at 7%. So looking at that, I think there's a lot of room for margin growth. Really, if I was going to say which one's the most direct competitor, or that I can real closely compare it with, I'd say closer to the Trade Desk. And even with the Trade Desk at a 27%, it's still considerably higher. So on my base projections, I still only have them at not even a 19%, an 18.4% free cash flow margin. So there's a real good chance they're actually able to increase this even more if they're able to keep the business running lean. And they could get this into the 20% range. But that's my projections I used for that in my base case. And in terms of how I actually ran that, the discounted cash flow, so these are the metrics I actually put in, like the 30% growth, the multiples, everything like that. And then I was using this actual DCF tool on Stock Unlock. I just kind of record it over here on this Excel just because it makes it very easy for me to come back and reference if I ever need to look at my inputs. Now, with that being said, I used a 3.5% dilution, which over the past 5 years, it has been 4.58%. But I imagine, because they have been buying back stock, so I imagine they're going to be able to keep their dilution limited in terms of that. Also on the earnings call, they were talking about how the actual stock-based compensation for a lot of the executives was going to be very performance driven, and that they weren't just going to get, going forward, the actual executives weren't just going to get stock-based compensation for just being there. They needed to hit their metrics to actually be rewarded that. So I believe with that, and with the stock price being depressed, they're going to be able to offset a lot of that share-based compensation. But to still be conservative, excuse me, I still ran this with a 3.5% dilution. Now, going into my base case. So I have right here, like we said, free cash flow growth of 30%. Now 30%, the price to free cash flow on the low end, I had 30, and then I had 35. Again, you can go back and look at the different metrics for some of the other competitors and what their price to free cash flow was. I thought this was fair based on what they were doing and their growth rates, and given that Zeta's on the higher end of free cash flow growth, I think they can command a multiple around the 30 to 35 range. Now, all of these are based, that's when I ran this, of the stock price as $18.66, and I used a 15% discount rate. Now, with that gives a low fair value if the stock was at a 30 price multiple of $34.85, meaning if you bought it at this price and these assumptions occurred, you'd get a 15% return over the next 5 years as long as you bought it at this price. Any lower, it would be better. So that'd be a low stock price in the future of $70, low CAGR of 30%. On the higher end, running this PE, or this price of free cash flow, of 35, I have a high fair value of $40, a future value of $81.77, and that is a 34% price to free, or 34% CAGR. Sorry about that. So you can kind of see the metrics on this chart, but even on my downside, I'm still looking at a pretty decent CAGR, and some people may be looking at this and like, okay, an ultra bear and a bear, 25%. Isn't that like a little excessive, or like pretty decent for a bear case? I'd say for normal companies, yes, but given the trajectory and what we know about the earnings currently and the trajectory of the business, I think these would actually be pretty bad numbers. It's all context driven, right? I don't want to just put this at a 10% because obviously that would be bad, but I still want this to be realistic. Do I think realistically they're going to be at a 10% revenue growth for the next 5 years? I don't think that's really realistic, so I don't see a point of running a bear and ultra bear case that I don't find realistic. Even with an ultra bear, 15%, that would be horrible. Because if we're saying right now their organic revenue, right now net revenue retention, I'm pretty sure is higher than 15% last I checked. So we're saying that would completely go away. No growth from the Marigold acquisition, basically zero acquisition in new customers. This would be insane. And if we're thinking of something like that, of a free cash flow growth of 15%, and let's say this did occur, of course, I'd have to play with the revenue numbers, but we're saying, okay, the free cash flow margins would compress this much, which I just don't see being realistic, which is why I went ahead and I had a 15 and 25% as my bear case. But even in these situations, still the CAGR is still a market beating return, or matching the market on my really low assumption. And then on the bull case, which I think has a higher chance of happening than my bear case, where we're looking at 35% growth. If we look at this, 38 to 43% CAGR. So when you start to see these numbers, you can kind of see why I've been so aggressive with actually buying this stock and why I've been so aggressive with it, which even here, let's say they kept the same revenue, but they were just kept the business running much more lean. So they were able to increase margins. That's still a 22% free cash flow margin, which I was showing you earlier. The other companies are able to still get, even on the lower end, around the 28%. So this wouldn't be out of the realm of possibility for them to make this 35% free cash flow growth, not even on the basis of a ton of revenue, but just on improving their actual free cash flow margin. And this is kind of why I've been buying the company so heavily. And even as the stock's been rising over the past week, I've still made it a consistent buy in my portfolio. And I do just have a lot of conviction on this company, especially from how bullish that conference call was, especially with the CEO talking about how Athena was starting to drive more engagement, not only with the actual businesses using Athena, but it's starting to drive it to where they have multiple use cases and they're starting to using it for multiple lines. And from what was said on the conference call, the more lines and the more they're actually starting to use Zeta, typically these customers start spending a lot more and start giving a lot more of their wallet share. Not only that, there's other mentions on the conference call of just new acquisitions of customers that just have a much higher spend budget. So maybe they have the same percentage wallet share of that marketing budget as they did with their past customers, but the actual total marketing budget of that company, because they're a larger company, it's just a much higher dollar amount. So net amount, they're still making a lot more from that. Hope I explained that well. But these are my updated projections for Zeta. This is why I've been so bullish on the stock. And this is why I'm going to continue to be buying, even though it's a very large position in my portfolio. Now, currently my plan is I'm going to start slowing my buying, not particularly because anything wrong with the projections or anything wrong with where I think the stock price is at, because as you can see from what I'm looking at, I have conviction in these. These are really great returns, but mostly because I did start some new positions, which I'm going to have a video out on that in a bit. Then I'm also trying to divert some of my money to those as well. You know, just always trying to keep the money flowing in different directions. And also SoFi has been getting hit recently, so I want to start buying SoFi a little stronger. So this week I can go ahead and let you know. So with Zeta, I bought about $75 worth of Zeta. I added to my position, and $50 went into SoFi. I had some other names I bought, but I'm going to save that for the next video. But going forward, I'll probably flip that and start doing more. $75 to SoFi, $50 to Zeta. So still buying Zeta, but maybe not as aggressive as it's starting to become a bigger and bigger portion of my portfolio. But again, as long as these prices stay depressed, I'm still going to be picking up shares. And I'll probably still be picking up shares for the remainder of this year. Whether the stock price starts to move or not, it does not matter to me. As long as these quarters keep coming in, the company keeps beating on their metrics, and I keep seeing positive signs that management is continuing to execute and that they're starting to gain traction and continue to take market share, then I'm going to be fine. Just keep buying and building my position as big as I can build it. So I want to thank everyone for watching this video. I hope everybody has a happy Memorial Day weekend. And if there's any stocks you want me to cover, any earnings or anything, please let me know in the description. Or if you have any personal thoughts on my projections, if I made any glaring mistakes on it or something you looked at and went, hey, you're not factoring in this, and this, please let me know. I'd be happy to hear that. And I just want to end it there.